$6.02 billion. I mean, wow. That is the staggering net income Royal Bank of Canada just dropped for the third quarter of 2026. To put that massive headline into perspective, over a 90-day quarter, that breaks down to roughly $66.8 million in pure profit every single day. Literally, that is nearly $2.8 million every hour. It's an undeniable financial flex that immediately caught Wall Street's attention. But what exactly is driving that mountain of cash, and more importantly, is it actually built to last? Welcome to this explainer. Leading up to this earnings season, the broader sentiment was actually quite anxious. With the lingering fears of a consumer slowdown and high interest rates really squeezing margins, Wall Street was holding its breath. And yet, RBC kicked things off with an absolute bang. Today, we're going to peel back the layers of those flashy headline numbers to understand the real mechanics behind the stock's valuation. We're looking at exactly where the growth is coming from, the hidden headwinds you absolutely need to know about, and what all of this data actually means for your strategy. Okay, let's dive into this. Here is our roadmap. First, the $6 billion headline. Second, 3 engines of growth. Third, the warning signs. Fourth, valuation and strategy. And finally, the bottom line. Starting right off with Section 1, the $6 billion headline. So looking at the actual underlying metrics, it's essentially a clean sweep across the board. Net income at $6.02 billion is a solid 11% jump year over year. Adjusted earnings per share landed at $4.28, and listen, that didn't just beat Wall Street's $4.08 consensus, it crushed it by a full 20 cents. Revenue is up 9% to nearly $18.6 billion, plus they returned $4 billion to shareholders this quarter alone through dividends and buybacks. No wonder the stock rallied 42% over the last 12 months. But how did they actually pull off that 20-cent EPS beat? Well, it wasn't just luck. It was driven by really rigorous, disciplined cost-cutting implemented late last year, combined with a smart pivot toward fee-based asset management, which naturally carries way higher profit margins than your everyday traditional lending. But here's the catch. In investing, the headline is really only half the story. While these results are objectively fantastic, we need to look under the hood. Which brings us to Section 2, 3 engines of growth. Now, what's really interesting here is how RBC's incredible diversification is on full display. Personal banking is still the biggest slice at $1.92 billion. But, and this is key, it actually saw a slight 1% decline this quarter. That wasn't because they lost customers, though. It was mostly driven by massive tech investments as RBC races to digitize the retail banking experience and overhaul their app, plus some lingering salary inflation for specialized tech talent. But because RBC is such a global powerhouse, the other 3 segments of the business easily made up for that short-term expense. The diversification is working beautifully. And here they are, the 3 growth engines literally firing on all cylinders right now. Wealth management surged a phenomenal 32% to $1.44 billion, heavily driven by a massive influx of new money into high-net-worth advisory services and a big spike in mutual fund sales. Capital markets, up 16% to $1.54 billion, with incredibly strong performance in corporate debt underwriting as companies rushed to restructure. And commercial banking delivered a really solid 12% increase, lending at $936 million, fueled by robust mid-market expansion and equipment financing. We're talking highly impressive double-digit increases across the board, outside of everyday retail banking. It's kind of like a giant flywheel spinning faster and faster over in wealth management. Step 1, you have good rising equity markets. Step 2, that boosts fee-based client assets. See, when the stock market goes up, the percentage fees RBC collects on those managed assets go up right along with it. Plus, they're seeing strong net sales with new client money pouring in. And step 3, that dynamic directly translates to higher profits. Meanwhile, over in capital markets, the investment banking arm is absolutely booming. We are seeing a major resurgence in mergers and acquisitions, specifically huge energy consolidation in Alberta and massive tech buyouts, as private equity firms finally start spending their cash. Companies are confident, they're expanding, and RBC is taking a very lucrative cut of that action. And we definitely can't forget that third engine. Commercial deposits rose 9% and loans grew 4%. Now, you might be wondering, why is a 4% growth in commercial loans such a big deal? Well, in a high interest rate environment, borrowing money is brutally expensive. For businesses to be taking on new debt right now, they must be seeing an incredible internal return on investment. It shows absolute corporate resilience. Canadian businesses are actively borrowing and investing in their own growth despite the higher cost of capital, and that's a really healthy signal for the broader economy. So everything is looking pretty amazing, right? Well, hold on a second. I want to pause here and ask a very important question. Is the market getting a little too optimistic? Analysts are starting to wonder if investor expectations for the banking sector are just a bit too high right now. Remember, capital markets and wealth management did incredibly well, but that was heavily driven by market appreciation, and markets simply don't go up forever. As one skeptical Bay Street analyst recently put it, RBC is priced for a perfect soft landing, but the runway is getting awfully short. That takes us directly into Section 3, the warning signs. Before we look at the specific risk metrics, let's quickly define a vital piece of banking jargon: provisions for credit losses, or PCL for short. This is simply the money a bank sets aside to cover loans that might go bad. Think of it as a rainy day fund for defaults. Understanding this is absolutely crucial. When you want to know a bank's real health and the true level of risk they're taking on, this metric is the ultimate canary in the coal mine. And this brilliantly illustrates our first major warning sign: $1 billion. That is exactly how much RBC had to set aside for credit losses this quarter. That's up 14% from last year. Now, sure, for a bank this massive, $1 billion isn't an existential crisis. But the trend? That's what is concerning. This increase is coming primarily from capital markets and personal banking. It tells us exactly where the stress fractures are forming. We're seeing everyday homeowners with variable rate mortgages hitting their trigger rates, forcing painful, sudden payment jumps. We're also seeing a sharp spike in credit card delinquencies as families are increasingly using 20% revolving debt just to cover the inflated cost of groceries and utilities. The easy money era of the pandemic is officially over, folks, and the bill is coming due. And beyond consumer credit losses, there are some pretty severe macroeconomic risks hanging out there. First up, market dependence. If we see a correction in the equity markets, those massive fee-based revenues in wealth management will cool off in a heartbeat. Next, we're looking at a highly fragile global trade environment. And third, external threats. Regardless of politics, the simple economic reality of potential U.S. tariffs poses a huge risk to the Canadian economy. If cross-border tariffs hit, the cost of goods spikes, manufacturing slows, unemployment rises, and naturally, loan defaults go straight up. Think of banks as the ultimate weather vanes for the broader economy. RBC is incredibly strong, for sure, but no bank can completely outrun an economic recession. All right, let's move into Section 4, valuation and strategy. So what does this all mean for you? How do we approach a stock that just delivered a world-class, record-adjusted return on equity of 18.1%, but is already trading near all-time highs? Investors have essentially already paid up for this growth over the last year. Do you buy the strength or wait for a pullback? Let's break this down for two types of investors. If you're a long-term income investor looking out 5 to 10 years, RBC remains a fantastic core holding. The dividend is safe, the yield is stable, and CEO Dave McKay is executing brilliantly. Just look at his recent $13.5 billion acquisition of HSBC Bank Canada. That was a generational move that instantly added a massive portfolio of high-net-worth commercial clients overnight. For the long-term holder, quarterly bumps just don't matter as much. But if you're an aggressive growth investor looking to open a brand new position right now, the risk-reward ratio honestly isn't particularly attractive. You'd be paying an absolute premium for earnings that might easily erode if those credit costs keep rising. For you, the smart move is likely sitting on your hands and waiting for a better entry point. And that brings us to our final section, the bottom line. Let's summarize the ultimate takeaways for navigating a market that is currently pricing the stock for absolute perfection. So the crucial point is this: patience and discipline are your best friends right now. You need to watch those credit loss provisions like a hawk in the coming quarters. If that $1 billion set aside keeps climbing, it's going to eat right into net profits. You also need to make these macro risks actionable. Set a Google alert for USMCA trade negotiations or US-Canada tariffs so you aren't caught off guard by sudden external shocks. Keep an eye on the Bank of Canada's rate announcements. And finally, mind your entry price. There is absolutely no shame in keeping your powder dry and waiting for a 5 to 10% pullback to secure a much better margin of safety. I want to leave you with this final provocative thought. RBC is the titan of Canadian banking, strong, resilient, and profitable. But even titans get tired. So is this titan just catching its breath, or is it starting to run out of steam? In a market that expects perfection, the smart money is always patient. Thank you so much for engaging with this explainer today. I really hope this deep dive helped clarify exactly what's going on behind those massive headline numbers. Keep learning, stay cautious, stay diversified, and I'll see you in the next one.